information conveyed in today's presentation is for informational purposes only. It is not a recommendation to buy or sell any trading instrument, and the opinions given by our presenter may change without notice at any time. We are recording this webinar, and we will post it to Trader Planet's video section tomorrow, so you will be able to review this material again whenever you like. If you're new to attending Trader Planet webcasts, you'll be pleased to know that we have previously recorded sessions on our site at www.traderplanet.com. Now, our presenter encourages questions and will allocate time at the conclusion of the lecture for a Q&A session. To submit your questions for consideration, please use the questions pane, which now appears on the lower right of your screen. Please use the questions pane so Carly will have just one location to view your questions and respond. Our esteemed guest presenter, Carly Garner, is an experienced commodities broker with DeCarly Trading, a division of Zaner in Las Vegas, Nevada. She is also the author of Higher Probability Commodity Trading, a trader's first book on commodities, currency trading in the Forex and futures markets, and commodity options. She also writes a monthly column for Stocks and Commodities magazine. After graduating from UNLV as a magna cum laude, Carly jumped into the options and futures industry with both feet in early 2004 and quickly became one of the most recognized names in the business. Her commodity market analysis is often referenced on Jim Cramer's Mad Money on CNBC, and she is a regular contributor to TheStreet.com and its Real Money Pro service. So let's all extend a warm welcome to Carly Garner of DeCarlyTrading.com.
Thanks, Darla. It's a pleasure to be here. Hopefully everybody can hear me okay. If not, please let me know through the question feature. It's probably the easiest way. Okay, let's get started. Today we're going to talk about technical analysis in commodities, specifically narrowing down which indicators to use and looking at a couple different quasi-broad definitions of setups. If you don't know me already, my name is Carly Garner. I am a broker at DeCarly Trading in Las Vegas, Nevada. We specialize in futures and options trading, anywhere from full service to discount online and everything in between. If you're interested in anything that we talk about today and you want to learn more, you can visit us at DeCarlyTrading.com. You can also find us on social media, Facebook, Twitter. My Twitter handle is @CarlyGarner. And of course, Instagram. I've written 4 books on commodity trading. The most recent is Higher Probability Commodity Trading. It's actually going to be officially released on the 19th, which is next Tuesday, so we're super excited about that. It is available for pre-order through Amazon, Barnes & Noble, or our website, higherprobabilitycommoditytradingbook.com. And some of the things that we talk about today are going to be kind of glimpses into what you might see in the new book. So before we get started, I just want to remind everybody there is a substantial risk of loss in trading futures and options. There's no easy money here. We're not investing and earning dividends or interest. This is speculating. We're trying to beat the markets, and it's not easy to do. If it were easy, everyone would do it, right? Okay, what is technical analysis? Most of you are familiar with what technical analysis is, but let's just make sure we're all on the same page here. Technical analysis is the practice of gauging past and present price action in an attempt to predict future price changes. Technical analysis is a pretty big basket of tools. It could be technical oscillators, which are basically mathematical equations plotted as lines. For instance, stochastics, MACD, all of these things that you've probably been using. And let's take a second to think about what it might have been like for traders 20 years ago before computers. If you can imagine, they had to not only calculate everything out with a calculator, then they'd have to actually plot it on a chart. If you can imagine, it was extremely time-consuming. In fact, this is before my time, but I know a lot of my older friends in the business, they actually had their charts mailed to them by post weekly, and then they'd open up the charts and they'd put them out on the table and they'd draw trend lines and all that sort of thing. And even when I got started in the business in the early 2000s, believe it or not, we faxed charts to each other. It was like, hey, did you see that chart on crude oil? And then we'd send a fax to our client or to our colleague. So times have changed. Nowadays, charting is a lot easier. Ironically, you'd think that with the advances in technology and the ease of charting and technical analysis, that the odds of success would be better for the retail trader, but it really isn't. In fact, I'm not sure it's any better at all with all this new information and all these new tools. So it's kind of an interesting phenomenon. But the idea of technical oscillators is basically we're going to determine whether a market's overbought or oversold. Trend lines is also a popular technical tool. And there's also mathematical tools that seem absolutely crazy on the surface, but for some odd reason they tend to work more than they don't, such as the Fibonacci ruler and GANFAN. We don't have time to cover each and every technical tool available today. We're going to kind of stick to oscillators and the main ideas, but I just want to introduce the fact that there are alternative ways to do things. And again, just because today we're talking about technical analysis doesn't mean that's the only way to look at a commodity market. In fact, obviously it's not. Other traders swear by fundamental analysis. And it really, I'm not going to say one way is better than the other. They're just different, and you have to find what you can make work for you. That's really the bottom line. I wish there was some sort of black and white easy answer, but it just isn't like that. Trading is an art. It's not a science. Despite disbelievers heading the college finance classes across the country, I believe that there is some validity to technical analysis. I remember in college, our professors were adamant about price is random, technical analysis could never work. But guess what? It does sometimes. In fact, I think it does more than it doesn't. And there's probably some good reasons for that. We're all reading the same technical analysis books, so we think we're all noticing the same chart patterns and assuming that the market's going to react in a certain way. So maybe it's kind of a self-fulfilling prophecy. But I mean, really, if you think about it, commodity prices and therefore their charts, they really just display the cumulative opinion of all market participants. So the nice thing about that is the current price of any particular commodity, it already accounts for all known information and all speculative predictions. So in other words, the chart can sometimes tell us a heck of a lot more than the newspaper can or the guy on TV can, because guess what? The chart is already incorporating all of that information. It's a little naive to assume that we would be able to somehow get information faster than everybody else and react to it and make money on it. So instead of assuming that we can do that, we looked at technical analysis. One thing to consider when you're talking about trading solely based on market fundamentals is anytime you're trading on fundamentals, there's definitely a bit of guesswork involved. I mean, anyone that's ever traded grains will tell you the USDA will tell us one thing on one report, and then the next report is the opposite, and the truth is probably somewhere in between. There's a lot of guessing going on. And even if you do wait till you see the numbers, the USDA report or whatever market it is that you're trading, those numbers are usually delayed. They're lagging. They might have been from, collected last month, and we're just hearing about it today. So fundamental traders are really at a big disadvantage in regards to getting timely information. Okay, there are various methods of technical analysis, or I guess maybe a better way to put it is purposes. There are really three purposes of technical analysis. And even though we may all be using the same tools and the same guidelines, the purpose could be different. For example, some traders are using technical analysis for trend trading. Obviously, the goal of a trend trader is to catch a long-lasting rally or decline through trend identification. Basically, they want to identify the trend, jump on board, and go along for the ride. And we're going to talk about in a few minutes why Maybe that's not quite as easy as it sounds on the surface. Technical traders also sometimes employ a breakout trading strategy. It's intended to catch a ride on a momentum move once it's broken above or below resistance, or I'm sorry, above resistance or below support, as determined by various technical analysis techniques. Usually breakout traders are using trend channels or just, simple support lines, resistance lines. And counter trend trading, which is probably what we're going to focus on the most today, is the attempt to swing trade the market by buying into fear, which are market lows, and selling into greed, which are market highs. This is done by identifying overbought and oversold markets. So the purpose of your technical analysis isn't necessarily going to change the tools and indicators that you use, but it is going to change how you use it. So what I mean by that is trend traders might use moving averages, they might use slow stochastics, they might use the MACD. Counter trend traders might do the same thing, but instead of reading a particular indicator as a sell signal, they might be doing, for example, a trend trader will generally wait for several things to come into line, and usually trend trader signals are extremely slow. So sometimes a trend trader is just getting into a long trade while a counter trend trader is getting into a short trade. And they might even come to the conclusion using the same indicators and tools. It's just how you use them, what your strategy is, and what your personality, what works best for your personality. Not everybody has the wherewithal to be a trend trader, and not everybody is willing to sell into market highs and buy market lows. And we're going to talk about kind of the advantages and disadvantages of each as we go. Okay, trend trading has a couple of really big glaring advantages. Trend traders can walk away with some really big winnings. I mean, they can catch some big moves. And it's comfortable. The trend is your friend. If people see crude oil going up, they want to buy it because guess what? It's been going up for 3 weeks, so they assume it's going to continue to go up for 3 weeks or whatever. I'm saying hypothetically, crude's obviously been going up longer than 3 weeks at this point. But there are some really, really big disadvantages to trend trading, and I hope if you walk away from anything today that you kind of understand. I'm not telling you trend trading is bad, because guess what? There is, again, I'm going to say it a million times, there isn't a right or wrong way. It's what way you're most comfortable with. If you're uncomfortable, you're going to make bad decisions. You're going to panic and get out at the worst time. It's not going to turn out well for you. But if you're doing something that you're comfortable with, and you've back tested it, and you feel like the strategy itself works, then go for it. And if trend trading is that's fine. But for most average retail traders, it really does not work out. And here's why. Trend trading is a lot like swinging for the fence. You can see some really big winners because if the market moves in your direction and you catch a big ride, it can easily add up to a lot of money. However, what people don't realize is to create a technical trading method that catches the big trends, you have to play with deep risks, so the losers are big. A lot of trend trading methods will place their stop order ridiculously below the market, meaning they might be risking $5,000 or $10,000 per trade, and guess what? Trend traders really have a relatively low win probability. Every system varies, but I mean, a trend trader, I would say my estimate is you can average probably winning on about 30% of the trades. So you're going to lose most trades, but you're going to win some really big winners about 30% of the time. And you hope that your big winners offset your really big losses, which are roughly 70% of the time. That's an assumption, but I'm just kind of throwing out here. That's really the kind of the accepted probabilities. And trend trading requires deep pockets. I mean massive. If you want to trend trade and you want to hang on for the long haul, you really have to be able to sustain some big drawdowns, and you have to have enough money to avoid margin calls and that sort of thing. Trend traders are going to also see frequent false signals, and their signals lag a lot. And when I say a lot, I'm talking a trend trader, for example, with the Brexit situation a few weeks ago in late June, when the S&P dropped 120 points, it did it all in one day. I would venture to say that within a day or two of the Brexit, the trend traders actually got signals to go short. And so they're a lot of times selling after the market's already made its move, and they're hoping it continues to make that move. But most of the time it does not. So what they end up doing is a lot of times they're buying market highs and they're selling market lows. But they're willing to take the risk of doing that because they know one day they're going to catch a ride. Like trend traders probably did pretty well in gold recently with the big run. So here's just an idea of what life as a trend trader might look like. And just to reiterate the point, trend traders forfeit a higher winning percentage. They accept the possibility of big losses and risk giving back substantial profits before the prospects of a windfall winner. And even when they do catch a big ride, the nature of most trend trading systems is to trail stops very deeply, so they end up giving a lot of their profits back. So also keep that in mind. All right, so you'll notice this is actually crude oil. I don't know if you can tell that, but this is crude oil. And if anyone that's ever traded crude knows you can make or lose a lot of money. Each dollar that crude oil moves is worth $1,000 to a futures trader. Knowing that, it's easy to see how a trend trader could really get chopped up before catching a big ride. See, this one would have been a great trade somewhere along the line, although actually it looks like they got a false buy signal, but eventually they probably would have, the trend system would have gotten them short there and they would have caught a big ride. Here you see they probably would have given a lot of it back. So, I mean, just to give you an idea, here's a false short signal. Here's a false long signal. And trend traders are always getting in after a move's already happened. So they probably sold the lows here, probably bought near the highs here. Let's hope that they got some sort of a sell signal and caught part of this. I'm not sure they would have because, to be honest, a lot of that's a big gap. So they probably missed out on all this and then went short somewhere in here, which is great. This would be a great short from 56, but I would venture to say most systems would have ran their stops pretty high. They probably would have had their stops about here. So guess what? They would have given back all of these profits. If they sold at 56, at one point they would have had an open profit of somewhere around 14 grand. Believe it or not, this is about $14,000. But in a couple of days, we're talking, this is a daily chart. So 4 days later, they would have given back almost all of their profits. They would have been given back like $10,000 worth of profits. So I don't know about you, but I don't have the stomach for those kinds of swings. It's just not in my gene pool. So for me, trend trading is just not an option. However, unless you can find a market that has super small contracts, maybe the e-microcurrencies or the e-micro metals or something like that, is probably a little more comfortable for most retail speculators when it comes to trend trading. But the average commodity would involve very deep risks and strong stomachs. Okay, breakout trading. I've never been a huge fan of breakout trading, probably just a personality thing, not because you can't make money at it or not because you're guaranteed to lose at it. I'm sure there's people out there that are smarter than me and have figured this out. But for me, breakout trading is probably a relative. In my opinion, it's a relatively low probability trading strategy. Again, that doesn't mean that someone else hasn't been able to figure it out, because I'm sure a lot of people have. The advantages of breakout trading is if it does work out, you could get a big winner. Also, it's kind of nice because a breakout trader is mostly sidelined. It's a little less stressful. If you're sitting on the sideline while until you get a signal, you're probably waiting quite a while, because there's generally market spend roughly, this is an estimate, I mean every situation is different, but roughly 80% of the time trading in a range. So if you're a breakout trader, you might only have, trading signals 10, 20% of the time. The disadvantage of breakout trading is there are going to be frequent false signals. Oops, that's a typo. You'll get a lot of false signals, and we're going to look at that in the next slide. They're called bull traps and bear traps, and they happen all the time, constantly. Because of this, breakout trading is a relatively low win percentage strategy. And breakout trading is similar to trend trading in that they're trying to buy high, hoping to sell higher, or sell low, hoping to sell lower. And honestly, most of the time, that's just not how markets work. Usually, like I mentioned a few minutes ago, they normally trade within a trading range. So with that said, trend trading and breakout trading tend to have lower win percentages, but bigger profit potential. So just keep these things in mind as we go. This is what I'm talking about when I say you get a lot of bull traps and bear traps. It's really easy to draw trend lines on a chart, especially now that we're not working off paper. But the problem is trend lines will give us areas of support and resistance. Not necessarily, it's not black and white. People expect, if support's coming in here at 41.25, they expect that to hold. And if it goes to 41.24, everybody panics and says it's a breakout. But guess what? It's really not. It can penetrate these levels by several points, and it does it all the time, just running stops, because most people, for whatever reason, they put their stops right here, above and below resistance. And so when those stops get hit, it takes the market quite a bit beyond the trading range. But once those stops are all elected and there's really nobody else there panicking, the panic runs its course, the selling dries up and the market reverses. And it did it here. Even in this situation where it eventually did break out and make a move higher, it was really messy. So would a breakout trader have actually made money on that? Maybe, but I have a hard time imagining that, and especially if they got caught on these bull traps and bear traps before catching a break up here. And of course, obviously not all charts work out like this. This just happens to be, I didn't have to search very hard for a chart like this, by the way, but sometimes you're going to pull up charts and you're going to draw your trend lines and pick out your breakout points, and guess what? It's going to work. But more often than not, this is what you're going to see. I tend to be a bigger fan of counter trend trading, and that doesn't mean, I'm certainly not the greatest trader on the face of the planet, and that doesn't mean that this is the only way to do it, because, it's not. But this is what I'm most comfortable with, and it's been my observation that this probably provides the highest probability of success. So anyway, the idea of counter trend trading is you're probably going to win more trades than you're going to lose, but the disadvantage is when the support or resistance fails, the losses could be comparatively large. Okay, sorry about that. All right, so the disadvantage of counter trend trading is you're looking at smaller wins. The counter trend trader might win more trades than they lose, but they're not going to catch the big ride. This is counter trend trading can be, in an earlier slide I mentioned you're basically buying fear and selling greed. Well, that's basically in line with Warren Buffett's famous quote: "Be fearful when others are greedy, and greedy when others are fearful." Okay, this is a chart of gold. It's a weekly chart of gold, and it kind of illustrates. First of all, it illustrates two things. It does show a couple of false breakouts. So if you were a breakout trader, you might have got suckered in a few times. But if you were a counter trend trader and you had enough guts to sell when everybody else is buying and buy when everyone else is selling, it probably would have worked out for you pretty well. You'll notice this indicator we've got down here is slow stochastics. Now, trend traders probably would have caught most of this move, but they probably would have given back most of it too, to be honest. They probably would have gotten short somewhere in here, caught the ride, and then given most of it back. Swing traders, on the other hand, they're trying to do a completely different thing. Swing traders are trying to catch the turns. So you'll notice in this example, the stochastics worked out pretty well. When stochastics gave a sell signal, the market sold. And generally, when it gave a buy signal, it moved higher. Now, it looks easy from here, from a distance, when you have no money on the line, but I can guarantee you if you actually bought in these areas or sold in these areas, you would have experienced quite a bit of stress, because it's easy after the fact, but in the heat of the moment, you never know if this is going to, support and resistance is going to hold. The problem with counter trend trading is if it doesn't hold, the losses could be substantial, and you really have to work hard to cut your losses quick enough to, not to ruin your year. Most of you have probably realized by now that this chart ends with gold being at 1226. Well, we all know gold is somewhere around 1350 now, got up to 1370. So a counter trend trader on this particular trade would have had a hard time, but that trader would have made money here, 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 here. So in other words, out of these 10 signals, the trend trader would have probably maybe made a little here and made some money here. So a trend trader would have made money on 2 trades, but the swing trader would have made money on 9 or 10 trades. So that perfectly illustrates what I'm trying to tell you. Swing traders are looking for the smaller base hits. Trend traders are looking for the home runs. Not wrong or right, just different. Somebody's asking if the majority of the charts that I use are weekly. Honestly, I look at weekly to get kind of a big picture of what's going on, overall. And then from there I go to the daily chart. I'd say I do most of my analysis on the daily chart just because the nature of futures and options is pretty quick. Like, in stock trading, a long-term trade might be 5 or 10 years. In commodity trading, long-term is a month or 2. So it's a little bit different ballgame. We're usually working on smaller time frames. But I definitely look at weekly charts to get my big picture, but the daily chart's where I probably would make most of the decisions. Okay, I've said this at least 5 times already, but I'll say it again. There's not a right or wrong way to trade. There's only the right way for you to approach the markets. The idea is you want to make sure the strategy matches your personality, and that's because you need to mitigate emotion. Emotion is really what makes the difference between making or losing money. Trust me, it totally is. I've seen traders with the exact same trading service, like they'll get a newsletter and it'll say buy here, sell here. They'll have all the same information, and one person makes money and one person loses money, and it really boils down to somebody panicked and got out at the worst time, or someone got greedy and traded too many contracts and ran out of margin. So it's really important to just stick with your personality, be comfortable, and if that means trading minis and micros and one lots, that's fine. Start there. If you find that you build up your comfort level and you can trade bigger, great. If not, that's okay too. The worst thing that you could do is trade beyond your means. Make sure that whatever you're doing, whatever strategy or position size is appropriate for your account size. Trend trading is absolutely not for the undercapitalized accounts. A lot of times people will try to trend trade in a $5,000 or $10,000 account, and if you get lucky and you hit a winner in your first 1 or 2 trades, you might do well. But most of the time, you're going to end up blowing out your account with and not having any fun at all. You might do it on 1 or 2 trades. To put things in perspective, if you've ever followed the phenomenon of trend trading, you've probably heard of the turtle traders. In a nutshell, they made a lot of money trend trading in the commodity markets. But to put into perspective, in order to do that, I can't remember what their risk limit was. I think their risk limit was 2% of their account on any trade. But the thing was, they were so heavily funded, they it would have been kind of the equivalent of buying a single E-mini S&P in a $200,000 account. So that's how overfunded they were. Just so you know, an E-mini S&P has a margin of about $5,000. So that's the equivalent of putting a $5,000 margin requirement in a $200,000 account. And to think of it another way, the E-mini S&P is roughly worth about $100,000 worth of stocks right now, with the S&P around 2,000, although it's a little higher than that, but we'll just round it. So the S&P is worth roughly $100,000. So that's like putting $100,000 in stocks into a $200,000 account. In other words, it's not only, you're not using any leverage at all. In fact, they eliminated the leverage to the fact it was opposite leverage. They were negative leverage. So did they do well trend trading? Yes, but it takes a massive amount of money to do that, to be able to do that. Okay, somebody's asking, do you believe price moves towards targets like high or low of month, week, etc.? I generally don't use daily highs or weekly highs as any sort of guidance on where I think pricing might go. Instead, I actually look at volatility and kind of measure what the volatility is and then make some sort of projection. So I don't really look at daily and weekly highs unless if the market is trading in some sort of a trading range and it's very clear where support and resistance is coming in, then I look at those, and a lot of times those happen to be highs or lows of the month, so on and so forth. Someone's asking if I compare time frames, and the answer to that is yes, absolutely. I'll go anywhere from a monthly to a weekly to a daily and make sure that everything still looks the same, because a lot of times you'll get signals on a daily chart that look fabulous, but then you look at the weekly chart and you realize, yeah, maybe not so much. Maybe this, the daily chart setting up for some sort of false signal. So you really want to compare the different time frames and make sure that they're all cohesive with the same overall idea. So my preferred technical oscillators, we're going to talk about that. And first let me just say there is no magic oscillator. Regardless of what I'm going to tell you that I prefer to use, don't let that sway your thinking. Really, technical oscillators are probably all the same in the long run. If you took every buy signal and every sell signal that they produced, you're probably going to come out about the same regardless of which one you pick. They're all based on the same historical price data. They tell us what has already happened, and they attempt to tell us what might happen next. Again, they're all the same. Some are slow, some are fast, but in the end, they're the same. It isn't which indicator you use, it's how you use it. And again, the one that fits your personality. And like I mentioned, these are my preferred oscillators. They don't have to be yours. And even if they were, I'm not sure that gives us any more of an edge than if we use slow stochastics or anything else. But this is what I'm comfortable with, so this is what I use. Williams %R. It's a momentum indicator calculated using 14 days of price action. There's actually two versions of the Williams %R. The original and the inverse, and what I mean by that is the original version is kind of confusing because it works off negative numbers, and it'll say if the market is above -20, it's overbought, or below -80, it's oversold, and it's crazy to me. So I prefer to use the inverse. Most charting platforms will allow you to choose which you want to use. But in a nutshell, the way it works is if the Williams %R reads above 80, it's overbought. If it reads below 20, it's oversold. Larry Williams, the developer of the indicator, intended it to be used by trend traders, but I find that swing traders might find it useful as well. And as a disclosure, trading this and any other indicator is trickier than meets the eye. Even if the indicator works, a market can move dramatically against the trader before we find out that the indicator did work. Williams %R is actually a relatively quick triggered indicator. It results in and increased odds of frequent or false signals. So in other words, Williams %R is going to give you a lot of trading signals, but you're also going to get a lot of signals that are too early or even outright wrong. But when it works like magic. And because it's a quick indicator, you'll see that it can be pretty painfully early. So in this situation in crude oil, again, crude oil is crude oil is $1,000 per dollar. So this if you used Williams %R and you strictly went off that, you probably got in somewhere around 36. The market bottomed at 32. So you would have been $3,000 or $4,000 in the hole before it came back, and you might have made some money. And hopefully you held on long enough to see that point. However, the next time around, Williams %R traders would have gotten an absolutely fabulous signal. So it's an aggressive signal. It's an aggressive indicator, but when it works really well. When it's early, hopefully you have a hedge on. I actually prefer using, and again, any indicator you use, whether it's stochastics or anything else, you don't want to use only that indicator. You really want to make sure you're combining it with a couple different indicators and a couple different tools. I also look at the RSI, the Relative Strength Index. It's a momentum indicator that compares the magnitude of recent gains and losses to identify overbought or oversold market conditions. It's really simple. If the RSI is above 70, it's overbought. So swing traders might look at that as a place to consider being a bear. If it's below 30, it's oversold. So swing traders might look at that as a place to consider being bullish. And just as with the Williams %R, RSI, even if it works, it can be early. So there's no easy money, regardless of the indicator you choose and regardless of how perfect you think you're using it. So in summary, RSI offers a slow but more reliable trading signal. This is the exact same chart that we just looked at. If you remember, Williams %R triggered 9 or 10 trading signals from, this is actually the first half of 2016. So Williams %R traders might have traded 9 or 10 times. An RSI trader would only trade twice. But they're much higher quality trades. I mean, you can see these would be a lot less stressful than the Williams %R trader would have been. Of course, not everybody is patient enough to wait 6 months for a single trading signal, so just keep that in mind. That's something to consider. Another thing to keep in mind also, excuse me, the RSI, although the signals are not frequent, they can, this is kind of a perfect example because it worked like a charm. It's not always that easy. Even if the indicator is accurate, there are times that you can see some pretty big drawdowns, and that's going to be true of any swing trading system because you're trying to, you're trying to buy the low and sell the high, and that's not easy to do. So you have to leave room for error. Okay, let's talk about how to use indicators to the fullest. Well, I mean, it's going to be impossible for me to show you exact precise things in a class like this, but here's some basic rules to keep your emotions in check and make sure that the indicators are working for you instead of against you. If you're going to use oscillators to determine price extremes and trade counter trends, trade small enough to let the signal play out. I know there's a lot of traders out there that have the mindset that if I'm going to trade, I'm going to go full blast and put all my cards on the table. Well, the problem is you're probably not going to last very long doing that. Just because you have enough margin to trade 10 contracts doesn't mean you should. And in fact, any strategy you use, whether it's counter trend trading or anything else, if you're trading too aggressively, you are undoubtedly lowering the odds of success. Keep it small. Make sure that if your signal is $2 or $3 early in crude oil, you can hang on. Or you have the ability to, even better, you have plenty of margin and you're comfortable, you maybe have the ability to add on. Another thing, in addition to having enough money and being able to suffer a drawdown as a counter trend trader, make sure that if you are going to use stop loss orders, and I'm not necessarily a huge fan of stops, but if you are going to use stop loss orders, don't don't put them too tight. If you use tight stops, it's nice because you don't have a lot of risk per trade and you're comfortable, but the problem is you're probably going to lose on almost every trade you put in. You'll be stopped out whether the market eventually went your way or not. So a lot of small losses adds up to big losses. So in my opinion, slow triggered indicators work more than they don't, but of course they're not easy money. So when you're going through the indicator tree on your platform and checking things out, make sure you have at least out of the 2 or 3 indicators you choose to use, make sure one of them is slow, because that's going to keep you in check. The key, if you do decide you like the idea of counter trend trading, the real key to success is just being patient and waiting for the good trades. It's not easy to do. Make sure you have the appropriate funding. Make sure your personality is equipped to handle going against the grains. If all your friends are buying corn and you want to sell it, you have to be able to mentally cope with that. So this is actually just looking at the same chart we were looking at a few slides ago. And I just want to drill it home that you really, if you're going to trade counter trend, you're never going to pick the exact low. You're never going to pick the exact high. So make sure that you're able to stomach some big drawdowns and still have faith in the system. For those that do have faith, it generally will work. It's just a matter of being able to hold on long enough for it to work. Now, there's a fine line here. Just because it almost always works doesn't mean that it's going to work every time. If you remember 2014 and 2015 when crude oil dropped from $100, down to eventually in the 40s and 30s, anybody trying to counter trend trade on the long side would have really had a tough time. So keep in mind that there's never going to be any guarantees that these technical indicators are going to work every time, but they do work most of the time. It's just a matter of having the funding and the wherewithal to trade them properly. So I'm a big fan of corroborating indicators. Blindly following a single indicator is really counterproductive. You don't want to do that. If trading were as easy as putting stochastics on the screen and going with it, everyone would make money, and that's just not possible. Trading's a zero-sum game. For every winner, there's a loser. In my opinion, I think it makes sense to pick 2 indicators, or maybe even 3, but at least 2 of different trigger speeds to act as kind of a get set and a go. So for example, I like looking at Williams percent R as a get set, or a go small. So for example, if the Williams percent R is in oversold territory, you might want to look at some other surrounding things, seasonals, fundamentals, things like that. And if you happen to be bullish, maybe that would be a signal worth taking on a small scale, not a big scale. Because like I said, Williams percent R is going to produce a lot of signals, but they are less accurate. The go trigger, which would be something that would be a little more comfortable, is the RSI. If the Williams percent R and the RSI triggers, that might be a place that you might be comfortable getting a little more aggressive. Or for those conservative traders, maybe that's the time you want to jump in and simply bypass the Williams percent R altogether. So as with anything else, do not rely solely on technical analysis. It is simply a piece of the large puzzle. If we only looked at charts and didn't look at anything else, we would definitely be missing out on some clues that could save us from losing a lot of money or just being in the wrong place at the wrong time. So in addition to your technical analysis, be sure you're looking at the CFTC's Commitment of Traders report. That's the report that will tell us where the speculators are, where the commercials are. And believe it or not, you can get some valuable information in there. I'm not saying you always want to follow the speculators, but if the speculators have a really big position, it's kind of a red flag warning on the existing market trend. And we talk about all of these things in my new book, Higher Probability Commodity Trading, in quite a bit of detail. You also want to keep in mind seasonal tendencies. They should never be ignored. You know, sometimes the seasonal moves are inexplicable, but it doesn't matter. If it happens more years than it doesn't, you should be aware of them and trade accordingly. Also be aware of market sentiment. If everybody's bullish, it's generally a red flag that the trend is coming to an end, and vice versa. I'm sure all of you remember when crude oil was in the high 20s. Everyone and their dog on TV was talking about $10 crude or $15 crude. We know that obviously that never happened. At the time, it didn't seem too far-fetched, but looking back, you know, it was definitely an overreaction. And also, just be aware of the implications of a global margin call. Some of you may never have really been a part of something like that, but for example, in 2008, when all heck was breaking loose, stock traders were getting margin calls, commodity traders were getting margin calls. So what happens is all assets trade as one. It doesn't matter if there's a corn shortage or a soybean shortage. If everybody's selling to clear up margin, fundamentals don't matter. So just be aware of that, and that's something that's not going to happen very often. Maybe once every 5 years or so, you might get something like that, but just be aware of it. And again, if you have any interest in the things that we talked about today, plus much more, my book, Higher Probability Commodity Trading, will officially be out on July 19th, but you can pre-order it through Amazon, Barnes & Nobles, or through our website, Higher Probability Commodity Trading. And we appreciate everyone coming out. I'm going to see if I can answer some of your questions here. Okay, someone's asking, when would you use an option instead of a buy or sell stop to protect your futures position? Well, the great thing about using options for stops is, and this is like actually an entirely different class, so it's going to be hard to answer real quick, but the great thing about using options to protect futures positions rather than stops is that you have lasting power. No matter what happens, there's no such thing as getting stopped out. The option protects you 100% beyond the strike price, so you have absolute risk no matter how bad it gets, and you always have the ability for a recovery. That's, you know, if you've ever traded futures with stops, you know stop orders have a tendency to get hit at exactly the worst time. Right at the high of a move or at the low of the move, and it leaves you on the sidelines and chasing the market trying to get in, and it becomes emotional, and it's no fun for anybody. So options are a great way to protect risk on a futures trade without having the risk of being stopped out. The challenge is options are expensive. Options are insurance. It's not free. So you have to make sure you're doing it in a market that offers cheap enough premium to make it worthwhile. So every market is different because volatility and option prices go up and down. So there's not a hard and fast rule. But the great thing is the E-mini S&P now has weekly options. So it's not uncommon that you can find an option that expires in a week or less, you know, sometimes a couple of days. And they're really cheap, and you can use those to hedge your day trading in the E-mini S&P, or, you know, so on and so forth. So the key is you don't want to spend a ton of money on an option for protection. But if you can buy a cheap option, $500, $600, and it gives you 2 or 3 days in the E-mini with absolute limited risk, I think it's probably worth it. Someone's asking what period do you use on the RSI? Just the standard 14-day. My motto is with the technical indicators, I just use whatever the default is. I figure whoever created the indicator probably spent a substantial amount of time perfecting it, and you know, who am I to say that I can make it better? I've tried, and I haven't been successful in making it any better, so I just use the defaults in most situations. Someone's asking if I use springs and up thrust to counter trend trade. Honestly, no, I do not. I'm not really familiar with how to use them enough to probably incorporate that. I've kind of set in my ways, I guess. But I'm sure that there's definitely some value in that. It's just not something I'm familiar with or use personally. Okay, somebody's asking, do most commodities have seasonal cycles which are repeated on an annual basis? If so, can such cycles be relied on to guide trend trading? Thanks. Yes, absolutely. In fact, I have an entire chapter in my new book dedicated to seasonals. And yes, there are absolutely seasonal tendencies that happen on most years. Just like anything else, it's not a guarantee to make money, but if something happens over and over, you have to take notes and account for it. So as far as trading solely on seasonals, I'm not sure I'd agree with that, but if you have a market you're looking at and the chart is looking good, your technical setup is there and the seasonals are in line with it, and you look at the COT stats and those look favorable as well, then I think you've got something going. If you're trading just purely because of seasonals and without any other supporting evidence, then it's maybe not the best idea. Someone's asking if I use market orders often or only. Okay. Depends on the situation. I mean, I actually place a lot of orders for my clients because we are a brokerage firm. So when I place more orders for my clients than I ever would for myself. When I place orders, it really depends on the situation. If I'm placing options, I always use limit orders for options. First of all, the exchanges rarely take market orders on options, which is a good idea, because sometimes with the options, the bid-ask spread can be widened. So if you do enter a market order, then you're just being thrown to the wolves kind of in regards to pricing. But for futures, my motto on futures trading is if you're going to place a limit order to enter a futures market, it makes sense if you're trying to buy substantially beneath the current market price. Let's say you want to buy corn at, I don't know, 340, and the market's at 360. Then it makes sense to place a limit because you're trying to buy it on a dip. You're hoping that it spikes down and catches your order, and you write it back up. But if corn's at 350 and you want to be long corn from here, placing a limit order at 349.5 is really kind of silly. I can't tell you how many times I've seen orders not get filled because of the half a penny in corn or a tick in bonds. It just doesn't make sense. If you want to be long, get long, unless you're trying to buy on a substantially lower price. Someone's asking if it's my experience that 80% of all commodity traders lose money. That's kind of a percentage that's thrown out all the time, and I would say that that is probably pretty accurate. I wish it were not, but I think it is. Most of the people that are losing a lot of money trading commodities, I would say, are they're over leveraged. They're trying to do too much with too little. So there's definitely ways that you can shift the odds to your favor, but the undeniable fact is most traders lose. The nice side of that is, though, the 20% of the traders that do find a way to make money are making all the money that the other 80% lose. So there's the bright side. But you should never come into the commodity markets thinking that it's going to be easy money, because it takes a lot of hard work, takes a lot of time, and even then it takes a little bit of luck also. Okay, someone's asking to share some seasonal cycles for crude and gold. Well, I mean, the big trade in gold is usually going into, there's usually some sort of a bottom in gold, like late in the summer months, and then going into the winter months, it normally goes higher. A lot of that is due to the currency market. The dollar tends to be weaker in the second half of the year, and that pushes gold up. This year's maybe been a little bit different just because there's so many things going on with Brexit and the currency markets, but generally gold goes up later part of the year. Okay, I think I got all the questions. Okay, somebody's asking if I use correlations between an index like the DAX and Deutsche Bank. No, it's not something that I really look at, to be honest. Okay, someone's asking if I see HF high-frequency trading as a problem interfering with technical analysis. I'd have to say I don't think it's a problem, but it is a game changer. I've noticed that with the high-frequency trading, markets tend to get to extremes easier than they did in the past. Usually those extremes don't last long, and normally they are just simply unreasonable pricing. So you have to be careful with that. But I don't necessarily think it's a problem. One thing to keep in mind is, back when the open outcry pits were open, there was basically the floor traders were making the VIG, they were making the bid-ask spread. So it's kind of just, it's not that retail traders are at a bigger disadvantage now, it's just the advantage has been shifted from the floor traders to the computers, is what they call them. So I'm not sure it ruins anything, it just changes it a little bit. Okay, so I think I've answered most of the questions. If I missed any, or if you have any additional questions, please feel free to email me, cgarner@decarlitrading.com. You can also catch me on Twitter or Facebook, and you can visit our website, decarlitrading.com, for more information on trading. We have articles, videos, all kinds of educational things.